When you can visually observe that there is no candlestick reversal signals that break the trend or the sideways mode of this market, you can just basically assume this is a sideways trading market. We saw the bearish and left-right combo that started the downtrend. We saw the bullish harami that stopped the downtrend. But now we can see that it's not moving one way or the other. You see a few days of strong bullish, a few days of strong bearish, bullish, bearish. When you're trying to recognize what the overall market trend is telling you, the visual analysis from candlestick signals pretty much make that clear. The market doesn't know which way it wants to go. And if you can't analyze the benefit of knowing which way the market is going to improve your probabilities, you probably want to just sit out of the market until that changes. That same scenario is obviously seen in the NASDAQ, where the downtrend stopped, but you can see you're in a sideways mode with big up days, big down days, big up days, big down days. When you see that, all you can assume is you don't want to be in this market right now because there's nothing you can sink your teeth into. With candlestick analysis, you get the benefit of knowing which positions to stay in based upon pattern breakouts and expectations of what happens after those pattern breakouts. Right now, our position on PDD is maintained because once it broke out of this bobble breakout and gapped up, it hasn't sold off. We're probably in a 45 degree, with the final criteria being not only has it not trading back below the T line, it hasn't even been able to get back below the 3T line. And you can identify very quickly which sectors are acting the strongest. With all the indecisiveness in the overall markets, gold and silver stocks are still acting well. You can see our recommendation on AU has been based upon the fact that they've never been able to close below the T line. This uptrend remains in progress. And it doesn't matter whether that trend analysis is bullish or bearish. As you can see in our short recommendation on TLRY, the kicker signal, a very strong bearish signal, maintains this downtrend as long as you don't see a buy signal and a close back up above the T line. This is not rocket science. This is merely identifying the strength of the bulls and the bears created by candlestick reversal signals that the Japanese rice traders have illustrated for us over the last 300 to 400 years. And your scanning techniques, as well as participating in a chat room, such as the Candlestick Forum chat room, where you've got plenty of eyes looking for the same type of patterns. The identification of RD or RKDA was illustrating the fact that you had a best friend signal, a doji followed by a gap up, and the fact that they really couldn't close below the T line, giving you an uptrending J-hook pattern. So when everybody's looking for the same type of criteria, again, the best friend signal being one of your strongest signals, the doji gap up, tells you there's more likely a lot more upside, calculating if this is wave 1, wave 3 will be the same magnitude. That's not because of anything scientific. That's because that's how human nature works. And specific sectors can be visually recognized as to be whether they should be bought or stay out, as we can see in some of the biggies like Amazon. Which direction is this trend moving? Right now it's telling us that they aren't any stronger on the bullish side or the bearish side. It's moving sideways. So that's a very good place not to be trading. Candlestick analysis is merely the graphic depiction of what's going on in investor sentiment, telling you when there's a strong bullish market, a strong bearish market, or a sideways market that you don't want to be trading. That'll be it. We'll see you in the chat rooms.